So you don't even need to be a millionaire or even a US citizen to be able to buy your first property in the US. And in this video, I'm going to show you guys how you can finance these properties and the documents that you're going to need, as well as a house hack strategy that allows you to start with just 3 or even 3.5% down. Now, by the way, I do have something free for you. If you click below, you can download it. It's called the $10,000 Property Playbook, and it kind of shows you these different strategies so that you can get into your first property for way less than you otherwise would have thought. I've done it personally. So again, I don't like teaching from theory. I like teaching from practice. I'm going to share it with you because I think one of the things that really I struggled with and I dislike is the fact that information, it's difficult to sometimes obtain, right? Or it's, you don't know about it. Now, kudos on you that you've come across this video and you're going to learn a bit about it. Maybe you already know about it, but hopefully this helps you, because really nobody teaches you this stuff, right? You have to kind of go out and learn it yourself. So here is me showing you guys a few tricks to get into a property for much less than you would think, even as a non-millionaire and as a non-US citizen. So I've done this. Again, I'm not a US citizen, but there's different paths. So the first path we can think about, right? You got to pick these paths, but the first path is like owner-occupier, like you live in it. And the second path is as an investor, so pure investor. You're not living there. So this could apply as well to my home country of Ireland, where you're owner-occupier, or you buy what's called a buy-to-let. So as an owner-occupier, you're going to live there. This is the primary residence. That's what it's called. Now, this you'll be able to get into much cheaper, much more like in terms of a small down payment. And the interest rates are lower. They're the best interest rates you can get. But as an investor, you're talking about a much bigger down payment. So you got to come up with more money to buy your property. Kind of sucks, right? But there's also fewer income documents that you need. So it's a bit of a less of headache in terms of like trying to qualify for a pure investment property, like versus an owner-occupier. And what I mean by that is like, you're looking at that point just at your debt service coverage ratio. So they look at the property in terms of the rent. Can it cover more than cover the debt that you're taking on? You also need things like, for instance, like your ITIN or your individual taxpayer identification number. Or if you're a foreign national, there's other proofs as well. So if you're living in one unit, you can use what's known as Federal Housing Association or FHA, or even conventional financing, where you can get as low as 3 to 5% down. 3% conventional, 3.5% FHA. Sometimes you need a bit more depending on your credit. But if it's investment only, rather than you're living there, right? If it's investment only, then you can do your DSCR, your debt service coverage ratio. It's a different style of financing. You're going to need more in that case, 20 to 40% down, typically speaking. So in terms of the owner-occupier route, go into more detail now, in terms of the options, and this is for just to be friendly towards those of us that are not millionaires already. So this was my case when I was sort of first getting into real estate, right? Before I was a millionaire. Now the FHA, the 3.5% down, this is a great thing. You can buy 1 unit, 2 unit, 3 unit, 4 unit properties. So a 2-unit property is a building with 2 different apartments legalized. So it's like a duplex, a triplex for 3, quadplex for 4. Sometimes they can be stacked horizontally, sometimes vertically, sometimes even like in all kinds of weird ways, like 2 in the front, 2 in the back, or maybe it's like upstairs, downstairs. Maybe there's 2 units downstairs, 2 units upstairs, right, side by side, etc. But that's for the quadplex. And so it's okay if you have a 1 to 4 unit property and you live in one of the units, single family, duplex, triplex, quadplex. Beyond 4 units, though, you cannot qualify for. Now, the pros, what I love about this is my favorite thing. This is what I'm doing, and I have done in the past, and I continue to do. So I've done a 1 unit, 2 unit. I'm currently doing a 4 unit. I almost did a 3 unit at one point. So the pros are having a low down payment. That's a big thing. Not having to save up to so much money. Also, it's quite flexible in terms of the credit. You get the best standards in terms of lower interest rates, longer loans, so you can lower the monthly payments because you're spreading it out over longer terms. You can also use the rent from other units in the 2, 3, and 4 unit case. I love the small multifamily 2 to 4 unit case, what they're called. So you can use the rent from the other units to help qualify you. So, again, it's subject to the different rules, the FHA rules, but you typically, and I think in the 3 and 4 unit, you really need these self-sufficiency tests and reserves. So usually they ask you like for proof of outside of retirement accounts, do you have 6 months of reserves in terms of cash reserves to meet the mortgage? You can do this by looking at the rent. They'll usually take 75% of the rent. They'll look at like what the existing rent is, and sometimes they'll do projections, depends on the bank. And they might want, let's say, a 1, 1.2, etc. But they'll look at rentals and then they'll take 75% of that and they'll add that to your income to help qualify you. So you can qualify for a lot more in terms of like the 2, 3, and 4. In fact, each one that goes up, you can qualify for more. Even the limits are higher. Now, the con or the negative of this kind of strategy is that you will have to pay mortgage insurance. So this is basically MIP or PMI. MIP in the case of FHA or PMI in the case of conventional. If you're putting down less than 20%, it's a riskier loan from the mortgage perspective, the lender's perspective. So they want you to pay insurance in case you default. And it's usually a percentage that gets added to the interest rate you're paying. So if you're paying, let's say, 6% interest, it might be, anywhere from, let's say, 0.3 to, let's say, 1.3. And you can look this up. It depends on the state, depends on the percentage you're putting. So when you're putting, let's say, 15% down, you're only charged a small percent for the mortgage interest rate. Whereas when you're putting 5% down, you're charged a lot more. It just adds to the interest essentially. Kind of, it's like that, like the interest on the property. So it's the interest, but they'll add this PMI. Now the thing is that with MIP for FHA, it stays for the life of the loan, but you can always think about potentially refinancing. So getting another loan later to pay off the first loan so that you don't have to continually paying the MIP if you want. Or with the conventional financing, what I've done is you can basically get rid of the PMI once your ownership of the property, the equity relative to the overall value, rises above a certain level. Or alternatively, your LTV, your loan to value, starts to, so the value on the bottom is the value of the property. Once the loan, right, is a smaller percentage, it could be 80%, it could be 75%, depends on the loan, depends on the bank, depends on what you're doing. But I have found it to be true. If you wait naturally, it's usually 80%. But if you force it and you ask them to reappraise it, maybe after a few months or a year, if you've done some renovation, you think that property is worth a lot more, you'll pay a fee for them to come out. And typically they'll want, because you're forcing it, they'll kind of want the LTV to actually fall lower, to fall below 75%. In other words, you own about 25% of the property as opposed to just owning 20% of the property by just waiting the number of years. But at least you can save on the PMI by doing that, right? So it's condition standards. So I really think that the MIP and the PMI, as much as you might think of them as a con, I think if you look at the time value of money, it's better like just paying a few hundred usually or $100 a month than placing tens of thousands of dollars out there right now. Again, it's your opportunity cost of capital. You could be growing your money in the index fund, making you a lot of money on that. And that money could even make more than what you're spending, right? Depending on what you're doing. So if you're making, let's say, 7% a year, that's like $7,000 on $100,000. So if you have to put down, let's say it's a $50,000 difference, that's $3,500. Are you paying like $3,500 in mortgage insurance over the year? Probably not. So you're probably, at my perspective, again, if you look at like forward value or NPV calculations, net present value calculations, you can do this mathematically, but you don't have to love maths, right? You can do this, but you can also ask ChatGPT to do this for you at this stage. Now, another thing you can do as opposed to FHA is the conventional. As I said, that's your 3 to 5% down. You can do this on a 1 unit, 2 unit, 3 unit, 4 unit. Typically, though, for the 2 to 4 units, they'll want 5% down minimum. Now, if you've got lower credit, they may want 10% down. But the great thing is, again, you can remove the PMI with conventional once you have equity. This is great like for W-2 earners. If you've got a regular job, you can really qualify for a lot. Again, the problem with this is that there are tighter credit and income requirements than FHA. FHA, like, you get in really, really good for those people that you don't have much money, that don't have a great credit score. FHA can work miracles for you. That could be your first way. If you can go to conventional, I love conventional. I just think it's a little bit easier in certain regards. You can put down 3% for a single rather than 3.5% for a single. And it's a great way of getting in. I've done conventional. I love conventional, but if you're starting off, FHA could be for you. For me, I didn't want to have to refinance. Like, I was getting in low interest rates, so my bet was the interest rates could go up, and they did. So I didn't really want to do FHA and then a while later have to refinance at potentially a higher interest rate just to get rid of a small fee, the MIP. Instead, I conventionally financed, and I didn't have to take out another loan to get rid of the PMI. I just had to basically reappraise it from the lender's perspective after I had renovated it. So this is a final strategy would be USDA for rural areas, veterans, so VA loans. Now, that's probably not you if you're not a US citizen, but this is 0% down, like no out of pocket in terms of the down payment. If you're eligible, again, rural areas or veterans. Now, this won't spend much time here because a lot of immigrants probably won't qualify. Again, I am an immigrant, but it's worth noting. I said there was 3, but like there is a slightly different angle here, which is house hacking, which I love, and I'll talk about separately in another video. I have in the past. Typically, this is, you can do a light house hack if you've got a single family and you live and it's more than, let's say, 1 bedroom. Typically, it's probably not good if it's 1 bedroom. Like, you get someone else to help pay your mortgage. Maybe you rent out one of the other bedrooms in the property. So you live in there, you live in 1 bedroom, and another person, you get like a roommate, etc. They go in, they live in the other bedroom, right? They pay you some of the money. But more conventional house hack is where you get a duplex, a triplex, a quadplex, so 2, 3, or 4 unit. You live in one, and your neighbors or your tenants are living in the other ones, and they're helping to pay the mortgage. So again, this is great with the FHA with 3.5% down. You live in 1 unit, you use the other unit's rents to support the payment. Now, the other strategy is if you're not planning to live there, you can think about the investor option. So you don't need to have perfect credit to do this. This is really using the building as an asset to qualify for the loans. And this is actually true the bigger the property. Like, when you see these giant properties, a lot of the time, I mean, they're pretty much investors. Like, all the complexes going up, like the apartment complex, essentially, like that's investors. So, there you're looking at the debt service coverage ratio, right? Like, what is the actual, the debt, let's say it's one number, is the rent, let's say 1.2, 1.25 times the size, so 20 or 25% more per month, the rent or the income essentially from the property, more than the actual coverage of the debt, etc. This is just a ballpark, but you want to look at like qualifying, again, for the investment loans, you're qualifying not on your income, but on the income on the rent that the property can generate. Again, it could be 1, 1.25, as long as the debt service ratio is kind of bigger than that. So the income is at least as big or bigger than the actual debt service. So this is typically a case, though, with the investor loans, that the problem with these are you have to typically put 20, 25% down, and the interest rate that you're going to be charged will be higher because of the risk. You're not living there. You're not as emotionally attached to it. So there's a higher interest rate. It's more risky for that regard. And many lenders, like, they do allow foreign nationals, but here's where you got to ring around. You got to persist. You got to ring. When I was looking for loans in the past, be it auto loans or be it real estate loans to buy properties, be it like HELOCs, I just rang. And some places told me, no, you cannot qualify. And some people were even telling me you get 100% loans. So the variation is huge. So just ring. Like, you got to ring around, even if you're a foreign national. So this is great if you're self-employed and you don't have a regular job. Then an investor loan could be for you, because you may not be able to qualify conventionally, but you could qualify potentially on the investor side. Or if you're new to the US and you don't have great credit, then look, the credit score, the FICO, etc., the other ways, they don't care typically for the investor loans. It's about the property. It's not about you. So as much as you say, oh, I want to get my credit score up, when you get into the big boy, big girl kind of territory where you're looking at like Grant Cardone style, like the hundreds of units, or even like looking at 5, 6, 10 unit apartment buildings. Typically for these investor loans, they're not looking at like what your actual income is and what your credit is. They're looking at the assets, the property. What does the property generate? They don't care about you, they care about the property. So this is great if you're new to the US, you haven't developed your credit, or you are self-employed, you're not actually working for a regular job. This applies to people who also are from the US, right? So this is general as well. But if you're not, this video is mostly for those of us that are not American citizens or people who are just not millionaires. This is the way to get in, right, when you're starting off from scratch. Now, the ITIN, Individual Taxpayer Identification Loans, if you don't have a social security number yet, this is me. Like, I came here and for a few months I didn't have a social security number. It was really difficult. Like, I remember I couldn't actually buy a car because I couldn't register the car because I needed a social security number to register the car. So I had to rent, take public transport, or get taxis everywhere. I ended up just renting cars to get around. It sucked, right? It was really difficult to get by if you don't have a social security number. So using an ITIN instead of a social security number, you can put 20 to 25% down. That's common, that's typical. Now you'll pay higher interest rates and you'll pay fees, right, because of the more risk. There are very few lenders, but they do exist and it's very doable. So just keep that in mind, an ITIN loan, using an ITIN as opposed to Social Security. So you don't even need to have Social Security to get a loan. It's called an ITIN loan. There's also foreign national programs. From those of us that are watching this and you're not living in the US, you're not an American person, you can often put down, it's a bit bigger now, 30 to 40% down payment. Now, this will require international asset documentation, your passport or a visa, but also a US bank account. That's the tricky thing, that's the tricky issue, is having a US bank account. The rates are higher because it's a bit more risky again, but the underwriting itself, right, the bank is trying to assess whether they give you a loan, that's going to focus more on the asset as well as the house, as well as the reserves that you have for the asset and your own assets. So in terms of the documents and the credits that you need, look, you're going to need, in terms of your identity or status first, you're going to need your passport. You're going to need, like for me, like a green card, permanent residence, or an eligible visa. There's also the EAD. Now this is for non-permanent resident loans. These do exist if you're a non-permanent resident. I used to be a H-1B visa. There are certain programs like that. Now, income as well, you know, beyond status, your income, they're going to look typically for 2 years of employment or self-employment history. So the pay stubs, W-2 for regular worker, 1099 for contractor, like the foreign income is sometimes accepted with translation into English, and continuance proof, the proof of continuing this. Also the assets that they're looking for, like your bank statements, they're usually 60 to 90, 2 to 3 months of days that are seasoned, right? Like you want to see like the last 2 or 3 months. So very, very important, like to kind of have a clean sheet, right? For everybody, whether you're American or not, like going into these loans, you want to be very careful with what you're doing the 2 or 3 months before you basically go to get your loan. You've got to be on your best behavior. No large, weird purchases if you can avoid it. No, if you have money coming to you from the bank of mom or bank of dad or gifts, like, you know, you're going to have gift letters if your family are going to gift you the down payments, like, you know, and they're going to have to, that's going to be accounting for towards tax towards the end of the year below, you know, if you go above a certain threshold. So, you know, be very important with that, like your seasoning before. Whenever I'm going up to getting a new loan, you know, I am super like watching my credit. I'm doing that in general, but I'm even more so just before getting a loan for the few months beforehand. In terms of credit, so if you've got limited US history, then use alternative credit. So this could be like, you know, on-time rent that you're paying on time, right? Like show that you're paying every month. Show that you're putting money away into a savings account or stock market consistently every month. You're paying your utilities, you've not any missed things, your phone bill, etc. Or you could import international credit. Now, some lenders do accept reports through certain services that translate foreign credit. Also opening up 1 or 2 US credit cards early. This is what I did. Usually you'll have a prepaid card where you cannot use more money that's on the actual card. It's almost like a debit card, like you put money on it, but it allows you to build up the actual credit, and then you can kind of graduate from that. But keep the utilization. If you've got $1,000 of spend, keep it below 10%. So that's less than $100 on that card. Also, make sure that you pay on time, right? You don't want to get any dings against you negatively. So let's look at a quick example. So let's say you're looking at a duplex with an FHA, like a house hack, right? So we're going to live in one unit, rent the other unit out. Suppose that the duplex costs $400,000, and we're putting down the minimum for an FHA, which is 3.5%. For $400,000, this translates to $14,000. Now, there's also closing costs that you can typically think are about 3 to 4% of the property's value. So about 12 to 16 G, right, of the actual property. So at that point now, we're really kind of getting into a property for 14 plus 12 to 16. So that's about, 26 to around about 30,000. Now you can get in cheaper if you get seller concessions. And there's certain other grants you can apply for, although that usually requires extra stuff. So you can get part of the closing costs reimbursed to you, or all in some cases. Now the interest rate, it could be, again, it's going to change. I don't want to write specific interest rates in this video, but just let's say, suppose that an interest rate happens to be 6.75 to like 7.5. The market's going to vary a lot. Let's say your principal, interest, taxes, and insurance, your mortgage essentially, your PITI is your mortgage. So this is kind of your debt service plus your tax and insurance. So let's say that that's all combined 3 to 3,300. Let's say that's your kind of your mortgage. Now you're going to rent the other unit for about 2,000 to 2,200. This could be for like a 2-bedroom, 1 bathroom on each side. You're living in one, you're renting the other unit out. And your net housing costs in this case, right? So take your PITI, your mortgage, subtract the rent that you're getting. At that point, your living costs, right? Your net costs are 800 to about 1,300. And that's before maintenance, it's before other things. You've got vacancy, of course, if you've got management, if you're not managing it yourself, and other fees. But this is really often less than the local rent. Like, you're living for 800 to 1,300 a month in a 2-bedroom, 1 bathroom, when typically a 2-bedroom, 1 bathroom would go for 2,000 to 2,200. Well, that's pretty good. So after 12 months of living there, right, meeting the occupancy requirement, because if you're owner-occupier, you must live there for at least 12 months. And that's just so for you don't have mortgage fraud and things like that, right? So if you are to move out earlier than that, you have to have like really good excuses, and everything has to be legit. Maybe your job has changed, you're having to travel somewhere else for a job, things like that. It's gone to a different state or different city, you name it. You can consider after 12 months moving, and then keeping both as a rental. So you can live in one for a year and a day to be safe, and then look for another one. Now you can even search for another one before the year and a day. You can even qualify for one as long as you don't close. So let's say you moved into a property on October 15th this year, let's say, and next year your moving date is October 16th on your next property for next year, then that's fine. That's cutting it very close, right? But that's where people could technically do this every year, right? And that's how they can acquire properties with low down payments. Now, typically lenders won't take more than about 10, again, it varies, 10 of these kind of loans, right? And that's pushing it. A lot of lenders will stop after 2 or 3. Some depends on the size of the loan, the size of the properties. But if you're starting out and you've got tiny loans, small properties, and you gradually, like I like to think about like Russian dolls, like start with the smallest one because you want a legitimate excuse. Like, why are you moving from a 4-bedroom home to a 3-bedroom home? That's difficult. But moving from like a studio apartment that's 500 square foot to a 1-bedroom apartment or twin, and then moving from a twin to a single family, moving from a single family to a much bigger single family, right? That you can do. That's why I say, like, start small, start young. Even if you're starting whatever age, just start small, right? And then, because you could be 60 starting this, right? Just start small, and that way you can actually get into more properties faster for less money, quicker, as opposed to like, oh, I want to buy my dream home. So if you put off the future, or rather you put off the present, that instant gratification that you have to have your dream home. Well, then instead of in a few years, Instead of having a McMansion, you can have an actual mansion. This is how wealth is really made. So this is my strategy. It's called bank hacking, and it really works. It's not just my strategy, by the way. I do not claim originality for this. Other people have done this for years before me, right? This is an old, tried and trusted method, but I've copied it, I've made it my own, and it really works. So I moved into a single family and I low down 5%. And then after a year, I moved into a multi-family duplex and I put down 10%, and it was a bigger and better home. And now I am about to move into a quadplex, right, which is even bigger. And again, maybe like relative square foot in the same house is around the same, but I was able to do that over time. Now, of course, I actually, to go from the duplex to the quadplex, and it was almost single family, I did rent temporarily after living in the duplex for a year and a bit. And because I've been renting now for a few years, I've gone to a different lending company as well, because that lending company wasn't really willing to do much more of these things, of the residential financing. They were more interested in the investment financing at that point. But make it yours. So swap the 400,000 for your local duplex comp and just recompute. So just, if there's something you're looking at, like a local duplex, try to figure it out. Like, what is a local duplex in your area? What is 3.5% down? Add another 3 or 4% for closing costs, and you have your rough idea. Look at the local comps in terms of what does it, let's say it's a 2-bedroom on each side. What is a 2-bedroom rent on average? What's the median 2-bedroom in your area? What does it rent for? What would the mortgage be and the tax and insurance? Now look at the difference. You can do this for UBU. You can do this, try to figure out your own thing. So the cash needed and the closing costs. So you want to budget the down payment and 3 to 4% for closing costs, but also don't forget to add about 2 to 6 months, usually 6 months to be safe, in terms of reserves. This is going to vary by the loan, right, depending on what you're doing. The bigger the property, typically they want more and more cash reserves, more months of reserves, where they look at like things like your PITI and they multiply it by a certain number of months. So if you're light on cash, if you don't have much cash, here are some extra tricks, some bonus tricks just for you guys. So first thing you can do is ask about seller credits. Typically the seller can actually give you back a certain amount of the closing costs. Right? There's lender credits as well, right? And you can also ask about down payment assistance, and that you can do that in local grants. They're usually state HEAs, for instance. Now, there are some pitfalls to be aware of as immigrants. These are common. So the first thing is unseasoned funds. So having large new deposits with no paper trail is not good. So where did you get that money from, right? They're really looking at fraud and things like that. So be very careful with any cash and things like that, big deposits. Don't make anything close to the time. HOAs, that's your homeowners association, and municipal or city restrictions. So if you're planning on short-term renting, is it legal? What are the regulations? Are there income caps? Even medium-term rental, your homeowners association may not be too happy with certain things. That's why I don't typically like condos and homeowners associations. It works for some people because they don't have to take care of the landscaping. They don't have to take care of most of the building. Mostly the internal they take care of. The external, the roof, the landscaping, typically that's dealt with by the association. They pay a fee per month and they just don't have to worry about when the roof caves in. But I don't like it because of all the restrictions. It's almost like living in a dormitory when you were in college, or living with your parents, where they're restricting you on what you can do to the building. Now, of course, in historical areas, the local borough might do that, but in terms of there's a lot more restrictions in terms of what you can do in that area. They may have quiet hours. They may have something to do with your front door. Not that you want to be throwing ragers, and I'm not saying that. I'm just saying that there's way too much restriction in terms of what you can get away with an HOA. Like if you want, for instance, I loved external heaters, and I noticed that the regulation was okay in my area. I could get away with certain things, very specific, but my HOA, my condo, wanted nothing to do with it. I was renting at the time, so they wanted nothing to do with the heater. So my pleasure from having an outdoor heater disappeared overnight. I couldn't use it because of the actual place I was living in. Now you can typically have it, let's say within, it depends on the area, let's say within 15 feet of buildings and things like that, and there's all kinds of regulations. but they just didn't want anything to do with it. They said, oh, it's a fire risk. You know, the management doesn't want it. And it's like, okay, well, if you live in your own single family, it's very different, right? You can control what you do in your back garden up to a limit, right? But you've got more freedom, and I valued freedom. Also, if you have a non-qualified mortgage, prepayment penalties. So just check when you're looking at like the debt service coverage ratio, the DSCR loans, or the individual taxpayer identification, like ITIN loans, check the term sheet. Check, are there prepayment penalties, paying early? There are sometimes in the investment world, commercial financing, you're not getting the same length typically of loans, and you're also getting things like balloon payments. It does get more difficult as you get into the investor world. So another thing to worry about if you're a non-American person are things like the currency transfer delays. So it could be that you're waiting on currencies to come across from different countries. This has affected me in the past, right? You're waiting for banks to and banks, they can take ages, they can delay things. Even when you're in the US and you're doing certain things like selling cars, right? They can take 2 or 3 weeks sometimes. So there are delays, like also the currency or foreign exchange FX risk, right? So you may have like a drop in, let's say if you're in Thailand and you've got the baht and you're coming to America, now your baht might drop in value and all of a sudden you have to come up with more Thai baht, right? So it could be that, or you're in Europe and your euros kind of temporarily fall relative to the dollar, you know, that can be problematic as well. So just, you want to start your US banking early, right? Either transferring the money over when it's strong, when the currency is strong, and getting the money across so that you're not going to be delayed and have to miss on certain deadlines, right? You don't want to miss deadlines. Also, an issue is trying to buy in an LLC, limited liability company, first. Most lenders want you to close on the loan personally. Now, you can often deed the loan into an LLC later. A little different in the investment world. They can sometimes be a bit more forgiving of that. They're more expecting that you'll do that. But just for the conventional things like that, you can't really do that. So mind the due on sale clauses, by the way. If you are to like re-deed the property from your personal self into an LLC, also the insurance then changes, a lot of different things like that. So a little checklist of tactical things that you can do. This is a bit of a recap too. So the first thing is, step one, decide, are you going to be owner-occupier, like live in this place, or are you going to be an investor? Next, you want to get pre-approved with the right lender type. It doesn't mean you have to go for the property. It doesn't mean you have to get a loan. It just is looking at what is the size of my purse? What is the size of my wallet? So again, is it FHA or conventional? Or if you're looking at an investor loan, you're not living there, it's usually the DSCR or a bigger property, like 5+ units, or ITIN, these loans. When doing this, you want to think about lining up all the documents that you need and making sure that you're ready to go, having a folder on your computer and seasoning your funds, making sure, again, 60 days, 90 days, that everything is clean. There's no sudden like lump sums. You're not putting in gifts. You're not putting in cash into your account. You have to have a paper trail for everything. So then you want to think about pricing in the closing costs, usually 3 to 4% of the property, and reserves up to maybe 6 months of the expenses of the property in terms of the PITI, something like that. If you're house hacking, verify the rent comparable. So what are the rents that are in your area that would be comparable to your property that you're looking at? Is it $2,000 a month, $1,000 a month, $3,000 a month? What is it? And what are the local rules if you're planning on short-term renting? There could be rent ceilings, rent caps. You cannot raise the rent above a certain level. Get 2 property manager quotes if you're not managing the property yourself. If you're not self-managing and you want to reduce stress in your life, then try to get property manager quotes, at least 2. Underwrite 3 different scenarios. So you want to it's like stress testing essentially. So you want to look at a base scenario where, you know, this is what you expect, and to see like, can I cash flow? Am I actually making positive money? Or if it's negative money, can I afford to have this negative? What if, you know, rent falls by 10%? You're expecting a certain money, like $2,000 a month, but it falls by 10%. So instead of $2,000, it's actually $1,800 a month. It could be because of vacancy or because the market becomes sluggish. Also, right in a scenario that where the interest rate goes up by 1%, because if you don't freeze the interest rate during closing, the interest rate could jump up, for instance, 1%. Also, maybe because you're getting an investor loan, because the residential doesn't work out, if you still want to go ahead with the property, you'll have to get an investor loan, and it's usually about 1% higher than a residential loan. So will it work? Will the numbers work? Will you be happy if the interest rate is 1%, or content is the better word? Would you be content to continue going for that property if the interest rate was 1% higher? So by the way, I talk about all this for free and I share it with you. Below, you can click the link to the $10,000 property playbook. It shares all this stuff in terms about how I got into my first deal for less than $10,000 and how you can too. A lot of these financing tips that work not just for American people, but also for people who are non-Americans, right? So again, it could be that you're an immigrant and you're on a H-1B visa, or you're on a green card like me, like you're a permanent resident, or even if you're not, even if you're foreign resident, foreign national, right? There's different ways of that. So this $10,000 property playbook, really excellent. I wish I had it when I was younger starting off, but I'm sharing it for you guys. Remember that buying in the US as an immigrant isn't about being rich. It's about picking the right loan lane and documenting your story. So if you can live in like one unit for a year, then FHA lets you buy 2 to 4 units with just 3.5% down. So that really is good for these multi-families. And the other units, they can help you qualify. In terms of the investor lane, look, if you don't have a W-2, you're new to the US, look into the actual investor thing, the DSCR, debt service coverage ratio loans. If the property's rent pays the mortgage and more, you can often qualify with just 20 to 25% down. And in terms of credit reality, if you don't have much long US credit history, then use alternative credit like rent, utilities, or bring in an international report that you have. Some lenders will help accept it. But just a warning, right? The quickest way to kill the loan is a big mystery deposit. So season your funds. You want to be very careful the 60, 90 days leading up to it and paper trail everything. So don't chase the perfect loan. Just pick a lane, buy one property, learn the system, and then your second deal gets 10 times easier. Worked for me, and I hope it works for you. So remember, we don't have to do everything at once. We don't have to build our wealth by having a massive property and starting large. We can build our wealth one property at a time. So let's build your wealth one property at a time, and I'll see you in the next one.